The US economy hasn't been stable for the past years.
Is our country going to fail us?
What is happening to the dollar?
Mama, are we gonna die out of hunger?
Why are experts predicting worse for this year?
Why does Robert Kiyosaki hate the dollar so much?
Why? Why is that
Why
so?
is that so?
What happened?
Let me just say it again. I used to be on CNBC, but I say I don't invest in anything they can print. I don't invest in this, stocks, bonds, ETFs. I'm an entrepreneur. I start gold mines, destroy oil wells. I invest in cattle.
Let's face it, the US economy and most economies around the world aren't doing well at the moment. The US GDP dropped from a 5.9% growth rate in 2021 to a mere 2.1% in 2022, and experts are predicting worse in 2023. The US stock market is showing signs of wear and tear. Income inequality is a persistent issue, with the wealth gap widening. Trade tensions between the US and China, the Ukraine-Russia war, and Israel-Hamas conflict have only worsened the situation. If you're looking to make money or protect your money in this current economy, you've got to know more and be more skillful at the game than the average Joe out there. Robert Kiyosaki has a reputation of making money during economic crises, and in this economy, he has a lot to say by experience. In this exclusive video, we unveil the imminent market crash warning from financial guru Robert Kiyosaki. Robert Kiyosaki's statement, "I don't invest in anything they can print," highlights a strategic financial perspective. By rejecting traditional investments like stocks, bonds, and ETFs, Kiyosaki emphasizes the risks of assets tied to inflationary pressures from fiat currency printing. Instead, he champions tangible assets, gold mines, oil wells, cattle, which are less susceptible to market volatility. These choices are deliberate. Gold, a trusted hedge against inflation. Oil, with intrinsic value in our energy-reliant world. And cattle, a tangible asset with consumable returns. Essentially, Kiyosaki's approach underscores a key strategy of the wealthy: diversification into real assets to safeguard and grow wealth, especially during market downturns. In simpler terms, don't put all your eggs in one basket, especially if that basket can be easily devalued. Now let's see why your traditional investment avenues like stocks, bonds, and ETFs might just be setting you up for a roller coaster ride. Our pals at the Federal Reserve are trying real hard to pull inflation back from a lofty 9% to a cozy 2%. But Tompkins says that doing so will cause the economy more pain. The Fed, basically trying to put out a wildfire with a water pistol, might hike up the rates if inflation gets too cheap. Heaton H. Doshi paints a bleak picture, saying if inflation zooms off, the market might just go into a freefall. And guess what? The Fed's hinting at another hike. If they do, that's 12 hikes since March 2022. Remember that old saying about too many hikes spoiling the stock? Bonds are not doing so hot either. August 2023 saw the US 30-year Treasury bond hit its highest yield since 2011. Now, for all you bondholders out there, higher yields mean bond prices are falling. If you're thinking of selling those bonds now, well, let's just say you might be getting back, less than what you put in. Ouch. China's economy is in a pickle. This isn't about pickled vegetables. China, the world's economic juggernaut, is showing some cracks. Consumer spending, down. Factory production, slowed. And don't even get me started on the youth unemployment rates. It's so bad they've stopped releasing the data. With an ongoing real estate crisis, some are whispering about a Leafman-like moment for China. Tensions between the US and China aren't helping. Alex Etra puts it plainly. If China slows down, the global economy follows. Big names like Apple, Intel, and Tesla, who are all cozied up with China, might just feel the sting. Here's a horror story. Imagine pouring your money into a booming industry and then, poof, the government takes over, leaving investors in the cold. Remember Venezuela's oil companies? Yep, that's nationalization for you. Let's say you're investing abroad. The foreign government pulls a sneaky and devalues its currency to boost its exports. Suddenly, your investments aren't worth as much. It's like, going to bed with a bar of gold and waking up with a chocolate coin. That's very disappointing. Here's a gamble. Invest in bonds from a country that's politically shaky. What could go wrong? Well, a lot. Ask anyone who invested in Greece during the 2010s. Not a fun ride. Remember Mt. Gox, the big Bitcoin exchange that went belly up. Centralized systems, be it stock exchanges or crypto ones, have their vulnerabilities. Technical glitches, fraud, you name it. In the wise words of Robert Kiyosaki, perhaps it's time to think outside the stock box. With the traditional market looking like a scene from a suspense movie, maybe, just maybe, it's time to diversify and look at some tangible assets, but more on that later. Stay tuned! Did you know that a mere 7 companies make up a staggering 28% of the S&P 500? Yep, I'm talking about the big guns. Meta, Nvidia, Apple, Microsoft, Alphabet, Amazon, and Tesla. Now here's the jaw-dropping part. While the S&P 500 returned a modest 12.4%, these top dogs are strutting around with a 92% return. They're like the popular kids at school pulling up the entire class average. But what if we plug these 7 out? What's happening to the remaining 493 on the exchange? Entrepreneur Patrick Bet-David from Valuetainment certainly had a few thoughts.
If you look at the S&P 500 year-to-date returns, you will notice a number roughly around 12.4%. Could be higher, could be lower, but it's around 12%. You know what Magnificent Seven's return is for the year so far? Roughly 92%. So what happens if you take the 7 stocks out and there's only 493 stocks left? How's the S&P 500 doing? It's down. So the 7 are pulling the rest of the market, and it looks like everything else is okay.
It's worth noting, just like our dear Robert Kiyosaki's perspective, if they can print it, be cautious. Hold on. Before we continue, welcome to Wealth Circle, your gateway to financial clarity. Dive into the secrets behind the wealthy grasp money's dynamics and take your first steps towards a rewarding side income. Kindly subscribe to the channel and turn on notifications to discover, learn, and prosper with us. Whether it's governments or large institutions, there's potential for asset prices to be artificially inflated or plummeted like a rock. That's why Kiyosaki emphasizes tangible assets. Because with things like gold mines or cattle, you have more control and less. Let's say puppeteering. Let's talk about tax, my least favorite 3-letter word. An investor with shares in individual stocks has more control over tax loss harvesting than the same guy with stocks in an ETF. If stock prices tank, the savvy investor can sell shares at a loss, reducing capital gains and taxable income. But with an ETF, not so much wiggle room. Speaking of ETFs, ever heard of capital gains distributions? Investors sometimes get slapped with a tax bill when ETFs distribute capital gains. And let's be real, nobody likes unexpected bills. If you're wondering what to do with those capital gains distributions, you're likely going to reinvest them, leading to, yep, you guessed it, more fees. Now, let's talk about banks. Believe it or not, they're still hanging on the edge. A recent report highlighted a shocking scenario. If half the uninsured depositors pulled out their funds from 186 banks, even those with insured deposits could face losses. Remember the Silicon Valley Bank catastrophe? Exactly what happened. About $300 billion of insured deposits could be on the line. This is no child's play. It's a serious game of Jenga, where the wrong move could topple everything. Taxes again. Remember when France introduced a 75% super tax on high earners? That didn't go down well. It led to a celebrity exodus, with actor Gerard Depardieu waving adieu to France. Numerous wealthy folks considered relocating, all because of this tax hiccup. By 2015, the super tax was ditched, but it taught us a valuable lesson. Dramatic tax changes can stir the pot in unexpected ways. Lastly, when governments dip their fingers into the market pie, things can get messy. The 2008 financial crisis is a prime example. Unpredictable interventions, shifting sands, and many lost fortunes. Another great example is Turkey's 2018 antics, curbing short sellers during a currency crisis. It sent shockwaves through the investment community, particularly foreign investors wary of their assets' liquidity. In essence, the landscape of the financial world is volatile and fraught with dangers, especially in printed assets. Taking a leaf out of Robert Kiyosaki's book might just be the wise path. Focus on tangible investments where manipulation is harder and the returns are solid. After all, you can't print gold mine.
One of the saddest things about America today is not only are we the biggest debtor nation in the world, but when I was your age, only 20% of our budget went to entitlements. Today in America, it's 75%. We have all of these people saying the government should take care of me.
Stocks, bonds, ETFs, While they might command today's headlines, the discerning investor understands the unparalleled power of tangible assets. Let's explore this lesser-known terrain where the savvy safeguard their wealth, ensuring prosperity in times of financial turbulence. This, my friends, is like owning the secret recipe to your grandma's famous pie, only way more profitable. Did you know that the patent rights for the medication Lipitor, at its peak, generated revenue of over $13 billion in a single year for Pfizer? That's the true power of IP. Unlike stocks and bonds, IP can't be mass-printed, ensuring its rarity and value. When the markets tumble, having a unique idea or invention to bank on is pure gold. Robert Kiyosaki had the right idea. Why invest in the printable when the mind can conceive treasures beyond imagination? But if IP isn't your jam, perhaps the next point will tickle your fancy. The very ground beneath our feet. The rich have known for eons that investing in land and property is like a solid rock amidst the financial storms. For context, global real estate is estimated to be worth $280 trillion, dwarfing even the stock market. Now, that's a vast playing field. As Kiyosaki quipped, why put your money on a piece of paper when you can own tangible land? Real estate has tangible value. It's something you can touch, see, and even live in. No printer can churn out an extra Central Park. Intrigued? Hold on. The next asset is both a feast for the eyes and the portfolio. If you are enjoying this video, smash the like button. It helps the video reach more people. Thank you. Let's paint a picture. Pun intended. Unique art has forever been the darling of the ultra-wealthy. Remember when Leonardo da Vinci's Salvator Mundi sold for a whopping $450 million in 2017? Art isn't just about aesthetics. It's a tangible asset, resistant to the fickle nature of the stock market. Unlike ETFs and bonds, a Picasso can't be replicated at will. Kiyosaki's mantra, invest in the unprintable, fits perfectly here. After all, no one's making another Mona Lisa anytime soon. But if you can't swing a painting worth millions, our next topic just might be the treasure trove you've been digging for. Remember Kiyosaki's mention of starting gold mines? He's on to something. In 2020, the gold mining industry alone was valued at around $191 billion. Just like real estate, owning a piece of the earth, especially one with treasure buried beneath, is a wealth magnet. The catch? No one's printing more land, let alone land laden with gold. This refers to the rights to use certain radio frequencies. As our world gets more digital and connected, these licenses have skyrocketed in value. For perspective, a 2015 US Spectrum auction raised over $44.9 billion. It's a niche, unprintable asset, making it a gold mine for investors. Kiyosaki might not have been talking about airwaves, but the principle stands. Invest in what they can't mass produce. Think Apple, Gucci, or Disney. Their value goes beyond physical assets. It's the trust, recognition, and emotional connection they've built over years. And guess what? You can't print goodwill or brand trust. It's earned. Kiyosaki's advice rings true again. Tangible assets, even if they're in the form of a brand's reputation, hold power. Now, ready for some lesser-known assets that can be even quirkier? A piece of the Berlin Wall? These pieces of history aren't just for show. They're unique, tangible assets. The sale of a 3,000-year-old Assyrian stone relief fetched $31 million in 2018. The rich understand that history, unlike stocks or bonds, doesn't repeat itself in the form of tangible relics. From history to the cosmos, meteorites are literally out-of-this-world assets. Valued for their rarity, scientific importance, and sheer coolness, some meteorites have sold for over $1,000 per gram. That's gold territory. Investing in a piece of the universe definitely aligns with Kiyosaki's wisdom. After all, they're not printing more space rocks on Earth, are they? In 2010, an unassuming Chinese vase, once overlooked in an attic, was auctioned for an astounding $83 million. Taking a leaf out of Kiyosaki's book, real, tangible history often trumps printed assets. If you're ever in doubt, just think. They're not making more of the past. Collectibles with errors like misprinted stamps or oddly minted coins are oddballs in the asset world. Take the 1918 inverted Jenny stamp, which due to a quirky error sold for a staggering $1.6 million. Isn't it ironic? Sometimes the flaws are worth more than perfection, huh? If you're feeling this vibe, you'll absolutely love where we're heading next. Remember the dazzling Blue Moon diamond? It fetched a breathtaking $48.5 million in 2015. These aren't just pretty rocks. They're nature's artistry, eons in the making, and yes, unprintable. Kiyosaki's mantra, tangible over printable, seems to shimmer even brighter here. Imagine holding Einstein's handwritten thoughts or a letter from Cleopatra. Historical documents are tactile timelines, merging the past with the present. And Einstein's scribble on happiness? That went for $1.56 million in 2017. Authentic, unreplicable, and absolutely unprintable. A near complete T-Rex skeleton? That snagged over $31.8 million in 2020.
Since it was sold at auction in October 2020.
Of all these assets, which one will be the first one you will keep your money in? Let me know in the comments section. In today's volatile economy, mere accumulation isn't the key. It's all about cash flow. Emulating the rich means diversifying into tangible, unprintable assets, ensuring consistent returns. As Kiyosaki emphasizes, it's not just about being rich, but staying richer even when the printed world crumbles. Adapt, invest smartly, and let your wealth flow. This is what Robert Kiyosaki emphatically say about getting rich in the current economy. I'd suggest looking at the various asset classes and deciding what interests you. In my opinion, I like to see income coming in from all the asset classes: business, paper assets, commodities, and real estate. That's true diversification of your assets and a safety net that's a way of hedging your bets in any one investment arena or sector. Robert Kiyosaki is referring to cash flow or income generating assets, but this is what makes these assets so important in the current economy. Here's a revelation. True financial freedom doesn't mean amassing millions. The essence? Boost your monthly cash flow above your expenses. Once your lifestyle isn't chained to monetary constraints, you've got the ticket to chase what genuinely ignites your spirit. Embracing cash flow is your safety net against a common retirement fear. Will my savings last as long as I live? Instead of a finite pool of savings, invest in assets that consistently refill your financial reservoir. That monthly inflow ensures a worry-free, replenishing nest egg. Imagine your glee when last November it soared to a staggering $68,990 only to plummet to a more sobering $20,000 area currently. Ouch, right? But here's the intriguing part. Mr. Kiyosaki believes there's a massive catalyst for Bitcoin's future: pension funds. As he referenced in a tweet, pension funds are the biggest investment businesses in the world. He highlighted Forbes' story titled, "Your State Pension is Now Gambling on Cryptocurrency." Isn't that a kicker? Now, as much as Kiyosaki adores gold, silver, and even Bitcoin, he won't claim they're the ultimate shields against financial woes. As he aptly puts it, gold, silver, Bitcoin may protect your wealth, but not your income. And what's the remedy he suggests? It's the humble side hustle. It's that little gig you undertake outside your 9 to 5. That might be your lifeline when the economy wobbles, markets tumble, pensions stumble, and unemployment rises. Remember, a side hustle not only offers extra cash, but might just be the prototype for the next big thing. Stepping away from bricks and into the world of stocks, Kiyosaki's Rich Dad Company advisor Andy Tanner throws light on dividend stocks as an intelligent way to earn passive income. We are unfortunately being programmed to only look at the stock price.
Exactly. That's why we're talking what we're talking about is the programming is price going up, price going up, price going up. It's insane. If you and I were to turn on CNBC right now, they'd be talking about the market going up or down or prices going up and down. They would show stock charts of whether the price was high or whether the price was low. Guys on Wall Street that are hired as analysts have to put a price target on there. They say, okay, we've looked at this company and this is where we think their price is going to go.
But, he insists, pick wisely. Go for the old guards. Companies that have weathered storms and consistently doled out dividends. But a word of caution. Avoid being lured just by high dividend yields. Dive deeper. And here's a tidbit for you. While dividend stocks may be easier to acquire than, say, a business or property, they're not Kiyosaki's top pick. Why? They might just be a tad too simple, fetching lower returns than other ventures. So where does that leave us in the vast sea of investments? And if you're not satisfied with what Kiyosaki think, or you are heading towards a more defensive financial plan, take a look at what Robert had to say about the rise of gold as a safe haven.